Hello, my name is Fred Baerenz, the President and Chief Executive Officer of AOG Wealth Management, advisor to AOG FX Institutional Fund. And I'm here this morning to talk to you about some of the pullbacks in public bank lending, which is significantly increasing opportunities in private lending. First of all, it's important to realize that more than half of banks have less than $250 billion in bank assets. That means that those are the banks that typically lend to small and medium-sized companies of less than 500 employees, and that's almost half of the workforce of U.S. companies. In looking at the growth of lending by U.S. banks, you can see a normal line here in 2022 as bank lending continued to increase throughout the year. However, after the Silicon Valley bank crisis, you can see that 2023 lending has not only flattened but actually begun to drop. The impact of that is that over the next several quarters, banks are expected to continue to lend less and less than they have been, which again is going to push more opportunity into the private credit lending sector. You can also see that after the Silicon Valley Bank collapse and then First Republic Bank, credit spreads have significantly widened on bond issues maturing between 5 and 10 years, which is going to increase the interest rates at which those companies have to borrow. Credit conditions continue to get more and more difficult for both small and large banks lending to borrowers. And you can also see that the willingness of banks to lend is now approaching levels not seen since the COVID downturn and even the great financial crisis, really not too far off from that if bank lending continues to decrease as expected. And we see this showing up in terms of difficulty in the economy with credit card delinquency, particularly among 18 to 29-year-olds and 30 to 39-year-olds continuing to go higher and higher. We also see that same credit crisis in auto loans now, with again, those same two age groups leading to delinquencies on auto loans not seen since the great financial crisis. And probably the most telling side is looking at where CPI is expected to be and how that's affecting decisions by the Federal Open Market Committee. Here we see what occurred in the 72 to 84 scenario where Arthur Burns thought that interest rates were down low enough and that the economy had inflation under control. And you can see that this is the crazy inflation curve that led to the double-digit unemployment rate and double-digit interest rates known as the malaise. This is where we are right now under Chairman Jay Powell. And you can see why he would be concerned, along with the other open market committee members, that if they lower interest rates too soon and inflation is not tamed yet, it could take off and be even worse than it's been before. So that's why I expect to see the Fed continue to increase interest rates in November and probably hold those rates higher for longer because of their fear of repeating the mistake made by Arthur Burns and his open market committee back in the 1970s. So the banks are going to continue to have to tighten their lending, and as they do so, there are opportunities for lending in private markets, which we think will be a very good place to be investing. I'm Fred Baerenz, President and Chief Executive Officer of AOG Wealth Management, advisor to AOG FX Fund.